be some profit taking is what you're seeing. Hindalco, Divi's Labs, Ultratech Cement, Tata Steel, a couple of other stocks that are dragging their feet. In fact, metals is on the back foot this morning, and the PSU. So BPCL, ONGC are all in the red at the moment. Reliance, oil and gas in general is under a bit of pressure as we speak. So watch out for that. On the upside though, Eicher Motors is your big mover, up about 1%. You have Bharti Airtel, TCS, Bajaj Finance and Adani Enterprises that are moving up. Infosys is clawing back a tad bit. Maruti Suzuki ahead of its numbers is up in the green. Tech Mahindra and Titan are a couple of other stocks that are just trending higher a tad bit. And otherwise, the market is very, very quiet. I think, Nigel will have a lot more exciting stock movements to talk about. But the headline index is really not doing too much. Some of these stocks like Glenmark Pharma are trending at 52-week highs. RVNL, Ircon also at 52-week highs. But the stock of the moment in the broader markets is Mahindra CIE. Almost a 10% rally now on that stock. Posted a very good set of numbers.
Well, that's right, Sonia. Just to give you a couple of stocks more, these Gujarat-based companies, they are doing very, very well because of that policy that's announced. The Gujarat government, they have said that the Gujarat state PSUs, well, they could have to announce, bigger dividends, and various other corporate actions as well. So GMDC is up and about in today's trading session. You have JSPL as well that's up. You have GNFC as well that's up. So all that clutch of stocks, well, it's firing away as we speak. A couple of other notable movers today. Pull up Dalmia Bharat. The stock started off with a cut of closer around 0.5%. But a couple of these other cement names as well are taking a bit of a knock, anticipating maybe weaker than expected numbers. But I think for Dalmia Bharat, it's more a company-specific issue. You have Ultratech that's a little bit lower. Shree Cement is down close to around 1.5% or thereabouts. Indian Hotels as well is up close to around 1% in today's trading session. AU Small Finance Bank is now down close to around 2.5%. So clearly the street doesn't like that set of numbers. And MCX is down 4.5% as we speak. IGL as well added to the losers list, down 1.5%. The initial dip has got bought into the Nifty along the flat line after starting off a little bit lower.
Nigel, the stock of the day once again for the third day is RVNL, right? I mean, it's up 7%, which means in 3 days, and this is the first hour of the third day, in 3 days the stock is up 45%. So that is tremendous, right? I mean, for a name like that to do what it is doing, and it is coming up on huge volumes, and I won't be surprised if there are, I'm not sure if there are blocks or anything on RVNL, but volumes are really through the roof on RVNL. GNFC and GSFC, etc. Nigel mentioned those. Adani Green is up about 2.25%. That's coming up with large volumes. IRFC is absolutely flat. The other one is Ircon. Ircon, by the way, is up 2.5% right now. For the week, Ircon is up 13%, 14% actually. Another follow-up from yesterday is Bombay Stock Exchange. I mean, a lot of this seems just pure momentum. I mean, BSE was up 8% yesterday, out of the blue. It's up another 2.5%, 3% right now. GMDC, we mentioned 7.5% higher there. RITES, for example, is another one. It's starting about 1.25% lower. For the week, 3 days, it's up 11% already. GSPL is the other one, which is up about 6%. So this is largely the list of what's moving right out of the gates. And it's looking good. And lots of volumes. It's not a low volume start at all. Now, on the downside, Bajaj, Sonia mentioned, is down. It's still down 1%. AU Bank is down a full 3% now, 642 on AU Bank. Abhishek was highlighting that for us. IPCA fell 10% yesterday. It's got another 2.5%, 3% loss right now. IPCA, that is, 720. The street not putting too much in terms of that acquisition of Unichem. Zomato is down 1%. Zomato is pulling back a little bit. It had a good 5-6% move yesterday. Persistent is down 1.25%. Numbers were not bad. 44.21 on Persistent, but stock's not done very much. And MCX is down about 4.5% there. The chief technology officer has quit. And the worry, of course, there have been this issue of the technology platform, whether they're going to implement their own technology platform, by when, whether this will lead to further delays, etc., etc. So that, I mean, again, straight off the bat, it opened 3% lower, is down almost a full 5% now. So that was a little bit of a dark horse in that sense, which is seeing a cut. I mean, I'm seeing lots of other 1.5%, 2% losses on volumes, which we can get to in just a bit. Z, Hindalco, IGL, Nykaa, Shree Cements, etc. are lower as well. The Nifty is flat. It's down about 20 points right now. Sonia.
I just want to make one mention on Mahindra CIE. I was going through the presentation and the numbers are looking very good, no two ways about that. But it's also a record high quarter in terms of margins for Mahindra CIE. Coming in at almost 15.6%. On an average, they've done 12 to 13% over the last many quarters, and now their margins have picked up quite a bit. But what the street might also like is the fact that the company, their tone is quite bullish in the presentation. They say that the India business is doing well. There are good expectations from that, and there is now stability in the Europe region. If you remember, Europe was a big problem pocket for many of these, auto ancillary players. But now they're talking about stability there. I think the street would like that.
All right, so that's Mahindra CIE Auto with a decent move right now. Our market master of the day is Mihir Vora, Director and Chief Investment Officer at Max Life Insurance. Mihir, good to have you with us here back in the program. Thank you very much for your time. It's earnings season, so I think we should start there in terms of what your assessment of earnings so far have been. Broadly, not too bad, right? I mean, actually, banks have reported pretty solid numbers. The rank and file are yet to report large segments outside of top tier IT and large banks, etc. So we're still awaiting those numbers. But first impressions right now.
Hi, good morning. Yes, overall, at least the large caps which have reported so far in technology, in oil and gas, even in some of the financials, all of them have reported decent numbers. So I don't see too much of an issue. And hopefully, with commodities prices coming off in the following quarters, we should see some of the discretionary and FMCG names also kind of show improvement in margins. So I guess the worry will not be so much on the margins going forward. We'll have to now see how the top line goes for most of these.
Okay, Mihir, hi, welcome to the show. Thanks for joining in. Wanted to talk about a couple of spaces, right, that are hot topics right now. One of them, of course, is autos, where demand has come back in a big way, but some pockets like exports are still under quite a bit of pressure. So in that context, what do you do with names like, say, a Bajaj Auto, which have already given you 20% returns this year? Do you see more upsides here?
Autos, I would say, it's still a mixed bag. While we see some amount of pent-up and low base effect in the two-wheeler segment, the passenger vehicles, which is the car segment, still is a question mark. We'll need to see this month's number. And initial indications are that there is some slowdown in the overall discretionary spend, whether it's in auto or even some segments. So I'm a little bit cautious about consumptions compared to, say, a couple of months ago.
All right. Hi, Mir. Good morning. Thanks so much for joining in. Mir, from the banking pack, we're still some distance away from the fresh all-time highs, but that's where the street is very, very bullish on. How would you approach the space? Would you go for the large private sector banks, or would you still find some valuation comfort on the PSUs?
I think it can be mostly the private sector banks, and even some of the NBFCs are now beginning to look interesting at these valuations. So I think we should look not only at banks in the private sector, but also the private sector NBFCs. And public sector, I would still stick to the top few, not really go down the curve. But I think as far as the results is concerned, it's been a great season so far. Most of the results in the banking space have been quite encouraging. And I don't expect any major negatives as far as the asset quality is concerned, even for the coming quarters. So I don't think asset quality is going to be an issue. We just need to monitor the margins because interest rates have gone up, RBI has taken rates up, and we are seeing a fight for deposits between all institutions, whether it's public or private sector banks. And of course, we also should see any signs of moderation in credit demand. So I think asset quality is not going to be the monitorable for the next few quarters. It's mostly going to be margins and top line.
Okay, margins and top line. Mihir, pharma is another space which has seen lots of deal activity. I mean, actually, this year so far, that's the only space which has seen lots of deals, in the private space and in the public space as well. Any thoughts here? We had Naren some time back who joined us, who of course looks at, sort of sectoral weights within the broader market, and when they get to extremes, I mean, he makes a call whether they're attractive, etc. He deems them attractive. And recently we've been hearing some positive voices that perhaps generic companies, etc., will start to see some relief. Stocks like Aurobindo in the last 1 month have done well. Do you like any of those? Have you bought any of those recently?
So in pharma, our preference is more towards the domestic market because that's where you have some pricing power and branding benefits, distribution benefits. As far as the US market is concerned, the call every year is whether the worst of the generic price erosion is over. And while we have seen some moderation in the rate of decline, which is decline in the rate of decline, but it's too early to say whether the worst is over. So I would still stick to the more domestic-oriented players.
All right, you would stick to the domestic-oriented players. I wanted your thoughts particularly on IT. Do you think the worst is over for the IT space? I ask because some of these companies have indicated that the client spends have not moved as much as perhaps what the fear is in the market. And numbers have also been good in the mid-cap IT space. You think the worst is over?
No, probably not, because we are still not probably the past. We are still probably not past the sharpest US recession quarter. So you might see some more deceleration in US corporate spending, retail spending, etc. So maybe things get a little bit worse before they get better. So I would be more cautious on US tech spending and by corollary the Indian IT services space.
Anything you're getting excited about, Mihir, lately? Any space?
We're sticking to the same themes, which is domestic overall doing better than the global. Especially government capital expenditure should continue very well in the election year. So all the construction companies, defense, make in India specific like chemicals, etc. So overall, I think domestic doing better than the global, and government support to some of the sectors like defense, railways, etc.
But does railway gel with that broader theme that you're talking about? I mean, stocks are flying. The problem with some of these sectors is that if you've tracked these things long enough, last 15, 20 years, it almost is a blind spot, right? Because for so long, these stocks don't do anything. They rally once a year and then they go back to being, and then something changes. And it's kind of hard to get your, get your head around that, well, it is changing and it is for good now. I'm assuming it's a problem many investors face, but the rallies are very, very large now on these names. What's your sense?
Yes, so because, after a long time, the government has made it very clear that we are going to spend a lot in these two areas, apart from infrastructure and road building, which has been the focus area in any case. But defense and railway spending has actually gone up. Indigenization is going up. And there are clear guidelines and steps being taken to procure more and more locally. So it can be a longer-term theme after a long time.
What about real estate? Everyone's talking about it. After a 7-8 year down cycle, finally real estate is coming out of the woodworks. But that's on the residential real estate market. What about the stocks? Do you see more valuation and growth upside?
I think so, because if we are talking about India, which has to grow at more than 6.5%, if you have to go to 7.5%, it cannot happen without real estate and construction and infrastructure. So for the next 5 years, if we do believe that we'll achieve anywhere close to 6.5-7% growth, then real estate demand will go up, both on the residential side as well as the commercial side. So it can be a long-term theme, and stocks are not that expensive in terms of valuations.
All right, Mir, what about these new age themes? One stock that's making fresh 52-week lows is, Nykaa. I think we should pull up the chart out there, and that was one of the few profitable ones that we were talking about just a year or so ago. What's your view on these themes, and are any of them coming to the value zone, or are they still very far away from it?
I think, new age is a very broad area. We are looking at it on a case-to-case basis. We do have exposure to a couple of names, but not in the retailing space. It's more on the insurance space, etc. So we are taking it one stock at a time, looking at the franchise values, the customer base, etc. for each particular company, then taking a call. Not really painting the whole new listings in the last couple of years with the same brush.
All right. Thanks a lot, Mihir, for joining in. Have a great day. We will speak to you again very soon. The market is quiet. It's not doing too much. But yes, the bias is on the downside. So the mid-cap index is down 120 points. The bank Nifty is down almost 200 points. So it doesn't look like it's a good start for the bulls. But Bajaj Auto posted a decent set of numbers. They were well above the street estimates. Margins expanded 220 basis points, came in at a 9-quarter high of 19%. The company also said that it's a sustained momentum on the domestic front that more than made up for the setback in exports. Rakesh Sharma, Executive Director at Bajaj Auto, joins in now to talk about that. Rakesh, thanks a lot for joining in. First, on the margins, it's come in at a 9-quarter high, but just wanted to understand that do you have any more margin levers for FY24? If yes, what are they? And what could the margin band be in FY24?
Good morning, Sonia.
Morning.
The sustained and improvement in margins is really on account of three things. One is, of course, we've benefited from the gentle devaluation of the Indian rupee, though the export component has come down, but that's helpful. Then all the cost increases which we have faced, which are not too much, but there are some incidences of cost even on account of the changeover to things like OBD2, though it was very recent. But the approach has been to judicially pass these on. And the third factor has been actually the most significant one, which is the richer mix. We are now, 60% of our domestic business is in the 125cc plus segment, which has a higher ASP and a higher margin. The three-wheeler business has done extremely well with a commanding market share of 78%. And CNG Auto is one of our most profitable products. Premium bikes of KTM and all have also done well. So when you put all that together, these have contributed to improving the mix. So you can see that all the three factors, even if I keep aside the devaluation piece, but the approach of judiciously passing on cost increases, in fact, I think we're the only ones who have passed on the cost increase of OBD2 in April. That and in continuing improvement in the mix should hold should do well for our margin. But as you understand, the Bajaj Auto margin is a very complex thing, a lot of moving parts there. For instance, if suddenly see a surge in Africa exports, Africa is generally less than the average. But if we see a surge in the three-wheeler side in exports, then that is at a very handsome margin. So where the where the penny will exactly fall is difficult to say. But this is the point we'll be striving to maintain.
So the reason I asked Mr. Sharma is, in the pre-pandemic days, right, in the heyday, so to speak, the hallmark of Bajaj Auto's numbers used to be 20% margins. And holding on to that level. Of course, things change a lot. There was, a big downfall as well in the sector. But now that things are improving, exports are also getting sort of back on track. Is there a possibility of holding on to 20% margins in FY24? Could it even get better than that, you think? That was my, question, whether there are more levers over and above what you spoke about.
Yeah, it's the North Star we have achieved. It's a watermark which we have achieved. And directionally, the approach of the company is to be very, very conscious of the bottom line. But, this is an optimization thing. And you have to optimize growth, market share, competitive position, and, of course, the margins. So we will continue to maintain that. And we are not numerically driven that we will sacrifice the other factors in the business to just hit that 20% line. But yes, as you can see, even in a very, very difficult year, the margins have improved. So that is a result of the fundamental approach of the company towards a better profitability.
All right. Hi, Mr. Sharma. Good morning. Good to hear some bit of optimism, actually. And even the read-through for the numbers are pretty good. I want to focus on the export volumes because that did get hit badly in the Q4. The monthly volumes came down to around 115,000. I'm reading a Jefferies note and they're saying that they expected to go to around 150,000 on a monthly basis. Though for the year, they're working with more or less flattish export volumes. Would you go with these numbers? Flattish volumes for FY24 in comparison to FY23? But the run rate improves to around 150,000 from around 115 that we saw in the past quarter.
Yeah, most likely they've put together this scenario after the analyst call last night. But, it's difficult to sort of pin it down to precise numbers from the company side. One thing I can tell you that in Q4, while the shipment numbers still are at a low profile, we have seen that the retail demand is improving in almost every geography. So Q4 was slightly better retail terms than Q3. However, there was one country which stood out, which is Nigeria, which is 25% of our exports, which had a difficult election and demonetization. So it was almost zero in February. So to give you an idea, we sold only 4,000 units in Nigeria in February and 28,000 in March. And I think we should breach the 28,000 number in April, not by too much, but a little. There's still a few days left and the numbers will come in. So you can see that at a retail demand level, the wheel is now just started to turn the other way. We would want to watch it for at least a quarter more. However, the second challenge in exports has been organizing the US dollars for trading. That availability is very poor. Central banks are very cautious, difficult to get letters of credit, confirmations, etc. Now, when that opens, we cannot say, but just sensing it in the basis of how much time it is taking for letters of credit to be confirmed, to get established, we think probably another 3-4 months, some kind of equilibrium will be reached, which means with the channel stocks low, the wheel turning the other way in retail demand, though gently, and if the dollar availability improves, we can look forward to better exports. But how much better, how exactly it will pan out, as you can understand, it is something which we will have to wait and watch and experience.
Mr. Sharma, good morning. We also had Mr. Bajaj with us a few days ago, and he was very confident and positive about what he expects the Chetak portfolio to be able to do and the vision to build that out in a very significant way. I think you've said that you will, the guidance is to do about 10,000 units a month from June onwards. Could you tell us if you're on track to do that, and can you provide some more numbers in terms of what can this portfolio really do for the company as a whole? What can this grow to, really?
Well, yeah, we have been very confident about Chetak as a product, its place, and we've taken a very calibrated approach to building the market. One eye has always been on a scenario where subsidy is reduced or even eliminated, and then how we would respond to our back-end vendors and front-end dealers, etc. So therefore, it has been a calibrated move. And when we were able to restructure our vendor system, negotiate better costs, and put a different kind of a cost structure to our product, we have changed the prices in March. And we've had a profound impact. It may not be visible to you because our retails only jumped to about 5,600 in March. However, we got handsome bookings, which acknowledges the fact that basically Chetak was a very highly preferred product, only its price was very high. And the supply chain side, the manufacturing side is resolving itself to start supplying about 10,000 units from June. Hopefully that is the time when demand and supply will finally meet. And after that, we are also expanding the footprint, which is currently 88 cities. By end of H1, we should be in about 120 cities with 140 almost exclusive stores for Chetak, which are, very nice stores with exclusive service centers, which contribute a lot to the brand building. So all those things hopefully will drive the Chetak beyond the 10,000. And later in the year, we will expand the portfolio. At this point of time, how exactly we will expand and what numbers we are going to gain from that, we will sort of talk about that later. But yes, scale-up phase of Chetak is now truly on.
Okay, all right. You know, I had one follow-up question to what Nigel was asking you about on exports, right? As the export recovery kicks in, what could you do on an average in terms of monthly volumes? Now, let's try and put the numbers. In Q4, monthly exports were around 115,000. Back in the day in FY22, your peak was around 200,000 plus that you would do monthly. At any point in time, can we get to somewhere in a mid-range, maybe 150, 160,000 in FY24? Are you looking at it July onwards itself? If you can give us some ballpark numbers on monthly exports.
See, Sonia, like I explained, that 200,000 is there. The markets will return to it. The whole question is the timing of it. And the timing of it is really dependent a lot now on how the international trade environment eases up. And that is anybody's guess, you know. So therefore, it would not be right on our part to put out a number because we won't have a logical basis. It's a field of improvement, but we don't have a logical basis to put out a number and give a guidance on that. Perhaps after quarter one, if we see an improvement, let's say by June, July, we will look at some scenarios for exports.
Okay, got it. So there's still a bit of uncertainty on the export side, so you don't want to give a guidance. On market share, you know, you ended FY23 with around 17.5% market share. I think it was the motorcycle market share fell about 100 basis points year on year in FY23. For FY24, what is the guidance? What's the company looking to deliver?
Well, you know, our focus to a large extent has been on the upper half of the demand pyramid, which is, you know, the 125cc plus, which has actually grown by 2.5% points or so in market share on retail term basis. And we will continue our thrust over there. It is in line with the market trends because that segment is completely outstripping growth-wise the performance of the 100cc segment. And we've got a lineup which is in line with the trends. It is already there in the market. It is doing well. And we continue to increase market share over there. You know, so we ended the quarter with about 28% on retail basis. I think we will continue to add over there. However, having said that, in the bottom half, at the entry level, there is a loss of market share. It's a little bit of a red ocean play over there, and we are conscious of the profitability standard. So we've not really participated in it through using the pricing lever. But we have made a major play in December and January, where we have launched the Platina 110cc ABS. It's the first 110 bike in the world with ABS braking system. And it's a very meaningful differentiation because safety is a huge concern. And that has started to chip away at market share. It's a difficult thing to, you know, convey differentiation at that segment. There is a major campaign. There are over 3 lakh test rides given. So there's a huge effort mounted by the company. And if that starts to improve, then the loss of market share at the very entry level will get mitigated by it. And at an overall level also, this surface level stagnation, which you see percent, which should start to improve on the basis of significant gains in the 125cc plus segment and, you know, mitigating the erosion in the entry level through the 110cc segment.
All right, got it. Mr. Sharma, thanks a lot for joining in and all the best with the quarters to come. I know this is a tough time for most businesses, especially the ones that have a global exposure. But as you said, seems like the worst could be over. Thanks a lot for speaking to CNBC-TV18. Well, let's slip into a quick break. On the other side, we'll bring you Q4 expectations from the metal sector in our special segment, Quarter Se Quarter Tak. We also have Ashish Kejriwal of Nuvama Institutional Equities, who will be there to share his views on the sector. Later, Rajesh Gupta, the director of Lloyds Metals and Energy, will be with us for an exclusive chat on their Q4 results. Stay tuned.
Okay, welcome back. We got what 45-point cut on the Nifty right now. We're at 17,725. Market breadth is also almost evened out, 1:1, almost 1:1, not quite, but almost there in terms of advances to decline ratio. As promised, our special segment, Quarter Se Quarter Tak, Nigel has moved across to the big wall to bring us expectations from the steel pack this time. Nigel, over to you.
Well, thanks for that. Watch out for a sequential improvement in the operational performance for steel companies in Q4 FY23. Now, in FY23, steel exports would have declined by nearly around 50% as a reflection of export duties that were imposed between May and November 2022. But during the past quarter, that channel has reopened, which would aid some recovery in volumes. Besides that, the margin improvement will be led by higher prices and lower to flattish coal prices. Companies with higher flats exposure, well, they'll benefit to a larger extent. Volume growth is likely to remain patchy as demand was volatile in phases in the past quarter. Debt reduction could also be in store for ferrous players, but that's mainly due to working capital unlocking. Now, the India EBITDA of ferrous players is likely to improve on a sequential basis by around 1,500 to around 2,000 rupees per ton, with higher realizations to the tune of around 1,000 to around 2,000 rupees per ton, and lower coking coal cost. Benefit that could flow through will be maximum around $10 per ton. Now, steel players with relatively higher reliance on exports are likely to benefit with better realizations. That's because in select overseas markets, well, realizations were a tad bit better. Tata Steel Europe, though, they'll report an EBITDA per ton loss as coking coal cost reduction sequentially is likely to remain insufficient to overcome the drop in realizations. Additionally, Tata Steel European volumes are lower by around 10% year-on-year, though they were a little bit higher on a sequential basis. The most critical factor to track for the ferrous companies is the EBITDA per ton. And as the chart shows, there's a steady improvement sequentially that will be seen. Investec says that for companies with higher long exposure like JSPL as well as SAIL, they expect the spread expansion of around 1,500 rupees per ton. This as rebar prices stand challenged due to holidays, monsoons, as well as working capital crunch as well that was witnessed in several infra projects. Now, most analysts are not too optimistic on JSPL's EBITDA per ton improvement due to the lower uptick in prices and on the back of a hit of higher raw material cost as well. The street will also be waiting by for commentary on demand and supply dynamics in the global steel environment, how expansion plans are progressing, particularly on JSPL, as they have a big ambitious plan that's underway. The capex of all companies as well as deleveraging targets for the coming year will be watched out for. Also, reports have indicated that the JSW Group plans to enter the auto space. Need to track if the listed entity has any role whatsoever to play in that directly. Well, let's wind this down with a check on the valuation. And as has been the case, SAIL trades at a bit of a discount as its promoter is the Government of India. Well, those are the expectations, but let's welcome Ashish Kejriwal, who joins us on the show, Director of Research, Metals and Mining at Nuvoma. Hi, Ashish. Thanks so much for joining in. Well, before we get to the expectations of the past quarter, the past few days, Chinese steel prices have corrected. Could you quantify what has been the pricing correction out there? And what is the average you are working with for FY24 with regard to the domestic steel prices? How far away is it from current steel prices domestically?
Yeah, hi, good morning, Nigel. Thanks for inviting me to the show. Yeah, as you rightly pointed out that China steel prices have corrected. That has corrected more than around $50 right now, $50 per ton in last 15-20 days. But at the same time, you have to look at that. One should not look only steel prices as a standalone. One should look at in conjunction with falling raw material prices also, which is iron ore as well as coking coal. So coking coal prices have declined by more than $125 in the similar time frame. And similarly, iron ore prices, global prices, that have also fallen by around $15. So net, your margins, that is Chinese steel producers' margins, have not declined in last 1 month, despite fall in steel prices. So that, I think one should take into account the margin front rather than only the realization front for any steel companies.
Okay.
And
sure. Ashish, just to drill it down to specifics, because I think that's what our viewers would also like. As Nigel was pointing out, for something like a Tata Steel, right, the EBITDA per ton is expected to rise quite a bit in the standalone business from 11,000 to about 13,000. Do you think that gives it a fillip in the near term? Could that lead to an upside in the stock? And what's your recommendation on Tata Steel itself?
Yeah, so in Tata Steel, in fact, we are somewhat ahead of the numbers which you have given. We think that they can do something like 14,000 rupees plus per ton in this fourth quarter. See, one has to look at in Tata Steel, third quarter was somewhat weaker than what other steel producers have reported. And it's not because of their gross margins, it's because of their other expenditure, which was somewhat higher than what we have expected or the street has expected. So I think that anomaly will get corrected in this fourth quarter, and Tata should report 14,000 per ton plus in fourth quarter. And that should lead to, you can say, somewhat higher uptick in the stock price also, because in the last 1 year, it has been somewhat underperformer because of Europe. Yes, Europe will continue to make losses at higher losses, but by looking at the spot prices, I think we can fairly see that Europe EBITDA per ton loss should bottom out in fourth quarter. So net, yes, Tata Steel, we think in the short term, around the results or post the results, the stock can give some rally.
Okay, all right. Ashish, what's the view on JSPL? Because long prices at one point of time, they were looking very strong. Now HRC prices have moved up at a faster clip. What's your approach to the stock? Valuation, it always enjoys some comfort. And they have a big, ambitious plan as well to scale up. Your view of the stock at current reckoning?
Sure. So, we are very positive on JSPL in the mid to long term. No doubt about it, because the kind of ambitious plans which they have, the kind of balance sheet they have, the kind of growth projects, as well as you can say margin expansion plans they have. So mid to long term, very, very positive, no doubt about it. Short term, yes, because of the pressure on the long product prices, stock is somewhat, moving here and there. But my sense is it's a seasonal in nature, because long product prices have increased faster earlier, which is somewhat normalizing now. And in first and second quarter, we know that it's a seasonality which will play, and long product prices could be here and there only. It should not move up. But even at 58,000 rupees per ton, it's on a much higher side. So my sense here again in JSPL, fourth quarter, my numbers will be higher than what the numbers which you are highlighting on your screen. I think they can do something like 13,000 rupees per ton. And, short term long product prices can be under pressure, but again, in second half, we can see, surge in the prices, or at least in the margins front. So we are comfortable on the margins rather than on the prices.
All right. That's actually Investec's, EBITDA per ton that we have put up for you on the screen. Ashish, final question before we let you go. Some reports have been indicating that maybe the JSW group will be looking at buying a stake in various automakers. A couple of rumors have been doing the rounds. What are you factoring in? My initial chats with various people from the management have suggested the indications are that it's unlikely to be via the listed entity. What are you factoring in? Do you think it'll be via the listed entity? If yes, what kind of a number are you working with? Or will you view it negatively with regard to capital allocation? Your take.
So I'm with you in that, Nigel. We don't think that this foray into the sector or auto sector will be through JSW Steel. It could be through JSW Group. So in case if it is through JSW Steel, obviously we will treat it as somewhat negative because of the capital allocation. But I seriously doubt that it will be through JSW Steel. It should be from the group side. So
Indeed.
We are not.
Okay, all right. Got it. Thanks a lot for that, Ashish, for joining in and filling us in with all of those details. We look forward to chatting up with you all through the metal earnings season. But as you said, you're pretty confident on companies like JSPL from here on. Talking about steel, well, let's focus on another iron ore miner. Lloyds Metals and Energy, they posted a rather good set of numbers. There's a big jump in the revenue front, led part by the mining division. Mr. Rajesh Gupta, the director at Lloyds Metal and Steel joins us, and Energy joins us on the show. Hi, Mr. Gupta. Good morning. Thanks so much for joining in. Well, in the past year, I think your dispatches were around 5.3 million tons or thereabouts in terms of iron ore. But the street believes that FY24 is going to be the big year because you've got the approvals for around 10 million tons. could you tell us what kind of a sales volumes should we factor in for FY24 on the iron ore front?
Nigel, thank you for inviting us. We have got the EC for 10 million tons. We have been doing a run rate of 10 million tons for many months, a few months in the last year, and we hope to continue that and achieve 10 million tons in this coming financial year.
Okay, so 10 million tons is something that you're looking to achieve in FY24.
Major unforeseen circumstances, we are very confident of achieving the 10 million ton target.
Okay. Do you have the logistics ready to dispatch these kind of higher volumes, Mr. Gupta?
In one word, yes. Like I said earlier, we have already achieved run rates of that volume in the last 3 or 4 months, like in December, January, and in currently also we are on that same run rate. We have 3 sidings in place, network of road which is being repaired by us at our cost, and all that is ensuring that the logistics is well in place from Gadchiroli.
All right, Mr. Gupta, you know, the EBITDA per ton, what are you making? You know, if I exclude the other income, I think it has an element of GST, I think so, out there. Could you tell us, as per your calculation, what is the current EBITDA per ton? Because it appears, you know, it's northward of 1,500 rupees. And where do you see this number holding? With iron ore prices have moved up in the last couple of months. So I asked you that.
So iron ore prices have moved up, but very steadily. And like the previous analyst said, that they might move down also. So I would say that the analysis would be that the future pricing more or less would be constant for the year. And given revenue, given the economies of scale, we should get a reduction in cost of around 150 to 200 rupees. Our current EBITDA per ton is around 1,800 rupees. So I think that is where we are, and economies of scale would kick in, and we should get a little better than that.
So then it will be 1,900 to 2,000 is what you wanted to guide approximately for this year?
Yeah. Yeah.
Okay. All right. Got that. Tell us a little bit about the way forward. Earlier, you had mentioned that you're looking at moving up the value chain, you know, perhaps through funding, through internal accruals, maybe through CAPEX as well. Can you tell us what is the CAPEX planned for FY24 to FY26? And what would that mean in terms of higher production for you?
So we are got the approval, went to the board and got the approval for 2 plants yesterday. One was a steel plant in Chandrapur of 500,000 ton of wire rods. This would be forward integration. We are currently selling sponge iron and power. That would be used internally. We'll be expanding our DRI and power capacity, as well as adding a arc furnace-based steel plant and a wire rod mill. That will be around 500,000 tons of a little higher grade alloy, low alloy but higher grade of steel wire rod. That's the first plant, and the second plant would be a 4 million ton pellet plant, along with the Maharashtra's first pipeline of slurry from the mine to the plant, which is around 80 kilometers away. And that will be 4 million tons with technology from Nifty GmbH, Germany. And put together, the total estimated capex is approximately 4,500 crore rupees. All of this is estimated to be spent through internal accruals only. That has been our mantra for some time, and we hope to achieve that going forward as well.
I'm just doing a back of an envelope calculation. I think the EBITDA for the year itself, you know, going by what you're guiding, 10 million tons and EBITDA of closer to 1,900 should be closer around 2,000 crores at least. That appears should be the rough calculation. Plus, you'll add this sponge and the other small contributions that you'll get. So 4,500 crores, mostly from internal accruals, is what you're telling us. The other factor that the street is looking at is you have another listed name, Sunflag.
It will be executed over 2.5 to 3 years. So this would give us ample room to ensure that our stakeholders are also rewarded in line with the thought process that we have right now.
You know, your stakeholders are wondering what's happening with Sunflag. That's the other listed company in there. and they have executed, they've gone and converted the optionally fully convertible debentures into shares. For some, that's an overhang now, because suddenly you have a large name in there who have 6 crore shares of your company. What's your view out there? I mean, any conversations between both of you all? I know you all were in a legal tussle, but have you all had any kind of conversation? Point number one. And is there a possibility that you all could look at merging both these two entities, or that's not a possibility at all?
Post the arbitration award and the execution of the arbitration award, we have very, very warm relationship with them. They are our consumers and our stakeholders now. And the overhang is there, but as it is, our liquidity in the share market is not too much. So I'm not really worried about that, but we have not had any conversation with them on any of these issues that you have mentioned. And there's no talk of any merger in one word, no. Yeah.
Okay, we'll let you go on that note. Thanks a lot for joining in and speaking to CNBC-TV18. By the way, the market may be quiet, but there are plenty of buzzing stocks. So let's take a quick break on that note and come back and tell you about all the big buzzers in trade. And also, Mitesh Thakkar will be joining in to help us with some 10 a.m. trades.